I'm putting on my CFP professional hat, but also my personal hat. And both of us, we're going to take some of the elements of this tax law that was signed officially into law on July 4th, and we're going to apply it to our own lives and the lives of our late starters. And it's getting to the end of the year, so we're all starting to think about taxes. So this is a timely episode. And I'm kind of a nerd where I actually read a lot of this bill, and I like to dig into things. And sometimes I have a different lens. So I'm going to be lending that lens to our conversation today. And there's a lot of hidden messages in here that I wasn't hearing anyone else talk about it. So we're going to talk about it today. This is a pretty big one that I think was important. So the Affordable Care Act, when you go to the healthcare.gov platform, you see the bronze plans. Typically, those are very high deductibles. There may even be some catastrophic plans on there, depending on your state. But here's the deal. The majority of those plans did not meet the qualifications to contribute to an HSA. So you got this huge high deductible and you still can't contribute to an HSA. It doesn't even make sense. So what this law has done is said, if you're on healthcare.gov and you're buying your insurance that way, if you have a bronze plan or catastrophic plan, now those automatically qualify to make contributions to an HSA. We've got this huge piece of legislation that has clearly said low fee is 0.1%. So it's out there now. I hope that 401k providers, employer-sponsored plans are taking note that this has been put in a major piece of legislation and they should be able to find 0.1% expense ratio funds to put into their 401ks as well.
The gauntlet is thrown down now, right? You heard it here, and for these accounts, we've now defined what is low cost. And all of our brokerage custodians out there pay heed because the government's going to give folks access to this. Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello, and welcome back to Catching Up to FI. We've been out of the chairs and off the mic for over a week. I've been working night shifts and I've been a little blurry, but it's time to get back in the saddle, talk to my lovely co-host Jackie Cummins-Koski, and update you guys on some of the things we think that late starters might need to know about the one big beautiful bill. This is going to be sexy. This is going to be fun. You never thought you were going to have so much fun talking about taxes. I'm going to function maybe as the host of this show, and my lovely co-host, Jackie Cummins-Koski, may function as the guest because today she is the expert.
Yeah, Bill, I'm putting on my CFP professional hat, but also my personal hat. And both of us, we're going to take some of the elements of this tax law that was signed officially into law on July 4th, and we're going to apply it to our own lives and the lives of our late starters. And it's getting to the end of the year, so we're all starting to think about taxes. So this is a timely episode. And I'm kind of a nerd where I actually read a lot of this bill, and I like to dig into things. And sometimes I have a different lens. So I'm going to be lending that lens to our conversation today. And there's a lot of hidden messages in here that I wasn't hearing anyone else talk about it. So we're going to talk about it today.
Yeah, I would refer folks back to our July 1st newsletter, because in that newsletter, we outlined several of the resources I think we used, and Jackie in particular used, to research the topic today, done by other influencers, other educators in the area. So sign up for our newsletter, and maybe we can push this one out again, or we can link all of these resources in the show notes to this show, Jackie, right?
Yeah, we'll definitely have all of this linked in the show notes. The IRS is just catching up, but they are putting out some fact sheets. So there's a lot to this bill. It was 870 pages. Now, I mostly just did a control find to look at the things that I needed to look at, or I put certain things through ChatGPT. I used the IRS, and there was a lot of other resources. So I did a lot of cross-checking because there is some bad information out there, some things that are incorrect. So we hope to clarify some of those and just to put it in practical terms. So why don't we get into it, Bill?
Yeah, I mean, before we get into it, you talk about there are three things we need to know about each change. Jackie, what are they?
Yeah, as I'm doing all of this research, some of them going to affect next year or the year after. Some are temporary, some are permanent. So we're going to make sure that we know the effective date of some of these changes. Like, is it temporary? Is it permanent? And if it is temporary, what are the effective dates? So we'll do that. We'll also want to know what are the income limits and phase outs in order to qualify for these, because some of these is not available to everybody. So if you're a high income earner or if you're above the income threshold, you may not qualify. And then lastly, is there a dollar cap on the amount of the deduction or the credit? So I tried to make sure I pointed out these three things in each that we're going to talk about. And we've got about 10 or so things, Bill, here that we're going to talk about.
All right, Jackie, let's dive in. First and foremost, what are the notable impacts on the two current laws? The things we're going to sunset, things we're going to time out. What in this law didn't change really, or what did it extend?
Yeah, so there were some notable impacts for two current laws. We had to know these very well when I was studying for the CFP exam. But the first one is the extension of the 2017 Tax Cuts and Job Acts. Now, I feel like people have gotten used to some of the things in these laws, like over the last 4 years or so, and it would be something like hedonic adaptation. So what's changing from last year? Nothing. So nobody's going to feel it, but I'll just highlight those anyway. So lower tax brackets will continue. And I have been studying this so much where I know these by heart. So I'm going to close my eyes. So the tax brackets will remain at 10, 12, 22, 24, 32, 35, and 37. So hopefully I got all those.
Yep, you hit it out of the park. Nice job, Jackie.
So I got those right. So those will remain very, very low. And a lot of people, especially financial planners and people in the industry, they thought that this was going to go away. They were planning for this to go away, but that will not change. So there you go. Next, it makes permanent the higher estate and gift tax. So if you happen to know anyone that has an estate of more than $15 million as a single and $30 million as a couple, these high numbers are going to matter to them. So that part got extended. And, I don't know if we have any listeners that's in this range, but that got extended as well. So the lower tax brackets is great. This increase in the estate tax exemption is only going to affect a few people that are at that wealth level.
Yeah, but it's important with regards to these things too, because we talk about the tax-free gift giving amount every year that we can do to our heirs. And people think, oh, I can only give $19,000 to each of my kids from me and my social security number. But in reality, they can give more. There's just a ceiling on it.
Right. Great point. Mostly in our conversation, in our Facebook group and the questions that we get, they're talking about the annual amount. So I think that's $17,000, $19,000 each year without having to file a gift tax form. So you can contribute through your lifetime up to, or you can give away up to these amounts that we mentioned. You would just have to file a form if it's more than whatever the annual amount is adjusted for inflation. So yes, the annual comes up way more than this big number throughout your lifetime. So that was the Tax Cuts and Jobs Act. Now, it was called the American Rescue Plan that helped with ACA premiums. So if you go to healthcare.gov and you buy your insurance off of the marketplace, the subsidies for that was enhanced and you got bigger subsidies. Well, that expires at the end of this year. So it's going to look like I do buy my insurance off of the exchanges I have since I retired. So I won't get the extra subsidy anymore. But the big part is the subsidy cliff. So for higher income earners with the old way or the current way, they were still getting a subsidy. They could qualify for a subsidy. But with the subsidy cliff, if you're 400 times the poverty level, then you get nothing. It falls off of a cliff. So let me just give you an example, Bill. So for 2025, the federal poverty level for a single person residing in the 48 states is $15,650. So 400% of that is $62,000. So once you hit that number, you fall off of a cliff and you get nothing. So that's just how it works. It more than likely will result in higher premiums that you have to pay out of pocket if the subsidies or less. So those are just the two things that one got extended, the Tax Cuts and Jobs Act. The other one did not, the American Rescue Act, that had these enhancement to ACA premium subsidies.
Well, this clip is important for especially firees who are controlling their income by doing Roth conversions or tax gain harvesting. And you've got to be very careful as to how much income you take in a given year, especially looking at it in the fourth quarter, right? Because if you go to $1 over this ceiling, you are losing your subsidies completely, right?
Yeah, you totally are. So just keep a lookout for that. Again, that didn't get extended, so it more than likely will result in less of a subsidy. And I think the platform for 2026 probably will open up in November. I forgot what the dates are. They actually shortened that window to do your open enrollment. But just when you see the net amount you have to pay for your premiums go up a little bit, that was because this particular law didn't get extended.
Chris Mamula wrote a great article on this that was linked in our newsletter July 1st, and we'll put a link in the show notes because he goes through his own example of married filing jointly with one child, and their income hovered right around the 400% of the poverty level, and he had to make sure that he kept it just under that ceiling. You can earn just enough, but not too much.
Right, right. And we got some smart friends that have been on the show that have been writing about it, YouTubes and things like that. So we've been devouring the content that they're putting out. So we will link you to that as well. If there's any particular topic that we're talking about today where you really want a deeper dive. So officially the first one, Bill, with this new law is the increased standard deduction. So not only did it get the lower tax brackets get extended, but now you get this increased standard deduction. Now, Bill, I know you see my notes now, but did you have any idea of how many people take the standard deduction over itemizing?
No, I knew it was about rule of thumb. I was thinking it was about 90%. That prior to its increase, it was much more significant, and itemizers made up a much bigger percentage of the deduction population. But now, I mean, it's so high that even high income earners are largely taking the standard deduction.
Yeah, so that changed a lot when they increased the standard deduction. Now, hardly anyone itemizes. Now, there's one provision in here that might encourage people to itemize or cause them to want to itemize, but for the most part, just about all of us are taking the standard deduction. If you're single, for 2024, the standard deduction was $13,850. Okay, with the change that's happening with this new tax law, it's $15,750. So it went up by $1,900. Married filing jointly, it was basically double that. And then I feel like sometimes the head of household get missed. Now, when I was a single mom, I would have been a head of household. That's a filing status. And I'll try to mention that when I can. But for the head of household, it used to be $20,800. And with the new law, it goes to $23,625. So those have gotten pretty high. That's helpful. And you will definitely see that when you file your taxes. That goes into effect for 2025, which you'll be filing those taxes in 2026.
All right, Jackie, we've got some other things to go through here. And one of the big things, especially for our late starters, is looking at seniors in this tax bill. It's hard for me to believe that I am close to being a senior. I'm turning 60, and while I can join the AARP, I still can't get the discount for matinees at the movie theater. I got to wait till I'm 65. But how are seniors looked at in this tax bill?
Yeah, well, fun fact, Bill, before I answer that, to be a member of AARP, there is no age limits. I always thought you had to be a certain age, but you actually don't. So even if you're the 30-year-old, listen to the show, you can get AARP. They do have some benefits, but we're talking about seniors right now, right? So this was one of the, I think, the most talked about provisions in here, okay? And I think it was partly talked about because there was some misinformation that was out there. Right after they announced this on July 4th, the Social Security Administration sent out an email, and it was posted on their website, that there was no tax on Social Security, which was not accurate, or they really implied that. And there's actually a revision or correction that was posted on the Social Security website. So this is worth clarifying for sure. So this extra senior deduction has nothing to do with Social Security. Again, it has nothing to do with Social Security. That is, tax remains the same. So this is based on age. You You have to be 65 or older. Bill, that means you'll miss out. So this is temporary. It'll go for 4 years. So by the time you turn 65, but here's the hidden message here. This could just be the beginnings of making this permanent, because there are certain things in the law that are made permanent after it being temporary. So this is temporary, it goes through 2028. So anybody over the age of 65, they get an additional deduction of $6,000. If you're doing married filing jointly, it's $12,000 for 2 people. And this is on top of, I don't know if you knew this, Bill, but seniors over 65 already get an additional deduction of $2,000 for an individual. So this is on top of that. It's a pretty nice boost for seniors. There is income phase out limits. Okay. So it starts to, for an individual, it starts to phase out at $75,000, your modified adjusted gross income. And then if it's a married couple filing jointly, that's so both of them over 65, it starts to phase out at $150,000. So again, there's an income limit and there's an age limit for this. Now, if you happen to itemize, you still get this extra deduction, so it doesn't preclude you from it. So that pretty much gets it. Now, I did have a little bonus that I wanted to mention on this. So check your state for additional deductions on retirement income. There's some states that don't tax retirement income. Like, for example, South Carolina doesn't tax Social Security, and it gives a $15,000 deduction for those over the age of 65. Now, I don't know if Tennessee has any extra deductions. I don't think they do.
I guess that I can say I'm not old enough to have cared yet, but I'm getting close.
You do know the answer, Bill, because Tennessee does not have income tax. So I did look up Tennessee, and they don't tax any income. So that's a nice plus. I also wanted to mention this fun fact. So for filing statuses, and again, for a big chunk of my life, I was head of household. And I feel like as I was looking at these tax provisions, they often left out the head of household filing status. So I'm like, how many people do file head of household? So here's the number. So filing single, how many people have that status? 50% of people file single, which is 85 million. Yep. So married filing jointly, 32% married filing jointly. So there's more people filing single. And then for head of household, 12% does head of household. And I've always been told, Bill, it's when you're married, it's so much better to file jointly. But there are still some people that are married filing single, and that's 3.5%.
Yeah, you have to talk to your accountant about figuring out which is more lucrative to you or beneficial to you. But I think it's important to point out the head of household status, because a lot of our audience would be single moms or single dads. Right. And this is the category they would fall into, just like you, Jackie.
Yeah, 12% of people. I know one reason why people may end up doing married filing separately is that for student loan purposes, there's certain little nuances with student loans where it makes way more sense to do married filing separately over married filing jointly. So anyway, I thought that was an interesting statistic that I wanted to pull out. The next one that we're going to talk about, it's been all over the news. It's been heavily talked about, and it really only impacts a few people.
We're talking about salt and pepper, right? But this is the salt part of it.
SALT stands for state and local tax. Okay, so this has been a big deal, but it basically raised the cap from $10,000 to $40,000 starting in 2025. And it's adjusted for inflation by 1%. And this one goes through 2029. After that, 2030, it reverts back to 10,000. So who does this impact? Okay, so if you live in a high cost of living area where property taxes are expensive, that's going to affect you. I'm talking about places like New Jersey, New York, places like that. Even places in Illinois, right? Chicago sometimes have very expensive property taxes. Now, also, it could be people, I haven't heard this mentioned very much, but it could be someone that has 2 homes. If they're paying property taxes on 2 homes, that could increase it up to that $40,000. Oh, and I guess another one is if you live in a high value home. So even if you're in a low cost of living area, let's say you live in South Carolina, which is a low cost of living area. If you live on the coast, those houses can be over $1 million and you may end up paying more. So do you know, Bill, which states have the highest effective property tax rates?
I'm going to say New Jersey.
New Jersey. Any other ones stand out?
Well, you might think you'd guess California too. I know definitely New Jersey.
Okay, so the top states as far as property taxes are New Jersey, so very good, Illinois, Connecticut, New Hampshire, and Texas. Now, California isn't up there. And this shocked me as well. And I'm like, of course, California has to be up there. They don't have high property tax rates. But what ends up happening, their tax bill is so high because of the expensive homes. And that's why many of them have a high tax bill. So for New Jersey, it's saying that it consistently tops the list. So it's not just 1 year. And the median property taxes is around $9,400. Of course, you got a lot that's above that where this would matter. I just kind of was looking through and just seeing, look at your state. Are you in a high property tax area? Do you have an expensive home? Do you have multiple homes? This may impact you. Also, one other little thing that I didn't hear mentioned a whole lot was the fact that there's a deduction for private mortgage insurance. So if you bought a big house and you paid less than 20% and you're paying PMI, then that's also tax deductible. So just a reminder is that you may also, if you're over 65, a lot of states, there's a homestead deduction. Well, you don't even have to be over 65, but if the owner is the occupant of that home, you get a homestead deduction from a lot of states. I know in South Carolina that was really big. I think if you lived in the home and you owned the home, it was like 4%. And if you didn't, then it was 6%. So just another little bonus that you could get and a reminder.
Well, these are not small numbers. I mean, I remember one of the big things for us with geo arbitrage from Chicago, Illinois to Knoxville, Tennessee was the bump in the gap we got by not having to pay property taxes in Illinois and Cook County, which at the time, 13 years ago, were pushing close to $20,000 for us then. It was not insignificant. And then we came to this area, and when we were just in Knox County, we were paying $3,000 of property taxes up till just a couple of years ago. We moved into the city area that doubled our property taxes, but still, we're in the $6,000 arena of property taxes, which is almost equivalent to what you pay for your house in Ohio, right, Jackie?
Right. I pay about $5,000 and Ohio ranks in the middle. So I used to call Ohio a low cost of living area. Now I call it mid cost of living because the property tax, that's something you have to pay every single year. And not to mention gas prices are typically higher. But yeah, I pay about $5,000 annually for my home. My home is valued at about $300,000, somewhere there. So your state of Tennessee is among the lowest. And where I'm originally from, South Carolina, that's among the lowest as well. So think about your state. Even if you're not quite at the 40,000, at least if you end up having to pay more than $10,000 now, you would have to itemize to get this. So let's point that out. So we talked about the fact that hardly nobody itemizes. Well, if you got a high property tax bill and interest that you can deduct, PMI and all of that, then it may make sense to you or for you to actually itemize your deductions based on this one particular rule.
Hey, Jackie, guess what? We got a new sponsor for the show.
Yeah, I am very excited about our sponsor, thealloymarket.com. It came to us through our partnership with the Financial Influencers Network. And what they do is help amplify the stuff that we're talking about and getting us with great partners like the Alloy Market.
Yeah, the Alloy Market has a great story. The founder had a medical emergency, needed to take a break from his job, but needed to keep himself afloat. He had some inherited gold and silver or platinum. He sold it, but he wasn't sure how to do it. He didn't know where to go, and he's not sure he got good prices. The Alloy Market buys your gold, silver, and platinum for excellent prices and helps you declutter.
Yeah, that is so cool. So, Bill, I am going to put this new sponsor through the test. So I forgot I had this little gold bar. About 10 years ago, a friend gave this to me, and it's 2.5 grams. So I am going to go online and get the kit that they offer and see how much I can get. Supposedly, they give you a lot more, at least 70% of what the spot price is. So I'm looking forward to that. But a long time ago, Bill, this didn't exist. And my old wedding ring, I had that thing around forever. I'm all about decluttering. So when I finally got rid of it, the only option I had was to go to like a pawn shop or something, sometimes a sketchy part of town. I don't even know if I got a good deal. So I am looking forward to Alloy and checking out their process. And you should probably check it out too.
Yeah, Jackie, we're very happy to have the Alloy Market as a partner. I look forward to finding out how your test goes.
Yeah, just go to thealloymarket.com. That's TheAlloymarket.com. So you can do the same thing, and I will give you an update on what I got for my 2.5 grams of gold.
Yeah, that's thealloymarket.com. That's TheAlloymarket.com. Look for it in the show notes. All right, now your favorite, Jackie. This is your favorite. And this would be something that may not have been as much publicized in the arena of this big, beautiful bill. And let's talk about the HSA changes that you saw in this.
Yeah, so HSA stands for Health Savings Accounts. We have 2 mega episodes talking all about it. Now, Bill, I remember you and I was discussing this before the bill got passed. They had all kinds of goodies in there for HSAs. A lot of that got thrown out. However, there were a few that were left that could be very helpful. So the first one is it made permanent that even if you have a direct primary care subscription, that you're still eligible to contribute to an HSA. It was this weird thing going on where it was not clear enough to say that a direct primary care program is not insurance. But if you were on a high deductible plan and you had a direct primary care subscription, that caused you to not be able to contribute to an HSA. So they clarified that, and they made this permanent, that now not only can you, if you have a high deductible plan, you can contribute to an HSA. The direct primary care does not preclude you from contributing, but it will allow you to use your HSA dollars to pay your monthly premiums for this, which I thought was great. I think it sends the message to be proactive with your health care. So they did limit the amount that is deductible, the amount that of the subscription. $150 for an individual, $300 for a family. Now, I believe that, is it Disha Spath? She was on the show. She's a direct primary care physician.
She was definitely interested in moving into this arena. In some ways, people look at this as concierge medicine, and it can give you access to a primary care provider that you might want so that you're not thrown out there trying to fish in the big ocean, and you develop the relationship, and they're obligated to you as well as you obligated to them to help you navigate a system that's become increasingly complex. So a lot of people, even in the FI community, are moving towards relationships like this.
I'm pretty sure Pete, Mr. Money Mustache, he uses this direct primary care, which is basically a subscription base. You pay a monthly fee and you get access to a physician for proactive, regular medical stuff. Is that, summarize it okay?
Not as much as I understand. Remember, I'm an emergency doc, so I'm dealing with the opposite end of that spectrum.
I know that I do listen to Disha's podcast. She is now a DPC provider. She just had a great conversation with another provider and how they set it up. So I feel like this could be the future of proactive healthcare, not just health insurance, but healthcare. And if you decide to get one, $150 is the monthly fee that you can deduct, which is not that bad, $300 for a family. So again, I think that this is a positive message. I'm glad that they clarified this. And I may even consider getting a direct primary care provider as well. Normally they will do like same day. And I just think it's a smart way to approach it. Have you ever used direct primary care, Bill?
I have not, but it's sort of taking back control of your own healthcare, and you're not limiting yourself to the corporatization of medicine where it's a numbers game and how many patients you can see, how fast you can see them. And this gives you the time and space and peace of mind to have quality conversations and plan making with your physician. So I may look into it too, Jackie, right?
Yeah, well, I think another thing is that I know that these will get a lot more popular, but they don't even involve insurance at all, right? They just get paid directly from their patients.
Fee for service, there are some that are like that, but not everybody can afford that. So the hybrid models are probably the way you want to go.
But I know that some of these direct primary care places were born out of getting frustrated working through the health insurance thing. And again, these are proactive things to do with your health to help you stay healthy and do it on the front end versus seeing you in the ER when it gets way too bad.
Yeah, I mean, but basically, we have to refer you back to Dish's past episode of She's the Frugal Physician, and we're going to have her back on to talk about this. This is not something sadly enough, I don't know much about it.
Yeah, I definitely want to have her back on to talk more about these direct primary cares. So, along the lines of HSAs, this is a pretty big one that I think was important. So the Affordable Care Act, when you go to the healthcare.gov platform, you see the bronze plans. Typically, those are very high deductibles. There may even be some catastrophic plans on there, depending on your state. But here's the deal. The majority of those plans did not meet the qualifications to contribute to an HSA. So you got this huge high deductible and you still can't contribute to an HSA. It doesn't even make sense. So what this law has done is said, if you're on healthcare.gov and you're buying your insurance that way, if you have a bronze plan or catastrophic plan, now those automatically qualify to make contributions to an HSA. That is pretty huge because I did a little more digging. So I put in my zip code, went to the exchange for the state of Ohio. There were 30 bronze plans for 2025. Do you know how many of them, Bill, qualified you or allowed you to contribute to an HSA?
What percentage? I'm going to wildly guess like 10%.
Yeah, that's very pessimistic. Good Lord. So that was even worse than what it is. Out of 30 bronze plans, I didn't do a percentage, but only 6 of them were HSA qualified plans. That's ridiculous. And I remember having this conversation with Sean Mulaney because he saw the same thing. I think Sean's in California. He was saying, like, why are so little of these available? There's a high deductible, but I still can't contribute to an HSA. Now, no need to overthink that. If it's a bronze or catastrophic plan on healthcare.gov, you can contribute to an HSA. This may change things for me. I've gone to a silver plan because I thought the bronze plans were so ridiculous with the deductibles and I couldn't even contribute to an HSA. So that might be helpful to a lot of people listening as well.
I do have something I want to mention here too, though, because my kids just turned 26, right? And they time out on our health insurance, and we have to self-insure because I'm a 1099 contractor, as is my wife. So we buy our own health insurance. We did not buy it off the exchange, and we chose to underwrite outside of the exchange, and there may have been a few little riders we had to take. But in Tennessee, this is a hack for some people to have this. We have Farm Bureau. And Farm Bureau is a very cost-effective approach to healthcare, and we have a high deductible plan that's worked very well for us. And it's HSA eligible at a really low cost, much lower actually than the government-sponsored plans. And what's interesting is that he migrated into age 26. One is migrating onto his own W-2-based health coverage. But my decision was, should I keep this other health insurance for them for a while until their lives settle down, because they could migrate onto our Farm Bureau plans and grandfather in to a high deductible plan where they would have access to an HSA, whereas they might not have that at their job. And so if they have secondary coverage that we are currently subsidizing, that would also be bridging insurance for them should they migrate to another job and they wouldn't have to go on COBRA. So the question for us became, okay, we have this great plan, they can grandfather into it. Should we maintain it for them as a quote unquote gift in order for them to have access to an HSA? So currently we're doing that. I don't know. What are your thoughts on that, Jackie?
I think it's wise to think through that. So this is a really pivotal moment where kids are no longer able to be on your insurance. I had to deal with it when my daughter turned 26. But I feel like, honestly, I don't know if you've looked at the plans on the HSA or on the healthcare.gov exchange for your kids, but they could probably get that for almost nothing, especially if they're lower income. They might get a subsidy to cover the whole thing.
They're at a rate of like $120 a month. So for me, for their high deductible plan. So, I mean, I could look at it and we're sort of at that point splitting dollars. And I haven't gone completely through that exercise because it kind of snuck up on us, the age 26. And I asked,
can you believe it that they're 26 already?
I know. Well, I asked the Farm Bureau. So what was interesting was they were exiting our family plan. What was interesting was that was a 4-member family plan. When we went down to a 2-member family plan, they didn't tell us we were getting any discounts, right? Okay. So we've gone from 4 to 2, but it's still costing us the same. And I called them back and I called them on it. And they said, well, wait a minute. Yeah, we didn't let you know that, but we do actually have a 2-member high deductible plan, and you can get another $120 or $140 off on your monthly. And I only got that because I called them out, asked them for it, And they didn't, of course, they're not going to promote it. When you have two kids exiting the building, you can pay less, but they didn't tell us we could.
Yeah, and for anybody that doesn't know, Bill has twins, so both of them went off at the same time. But that's really cool. I always remember that it was very cheap to add kids onto your insurance, but as soon as you add a spouse or a partner, it's a lot more. But yeah, you wouldn't have known that to get the extra discount unless you called. But I love your Farm Bureau insurance. You obviously had to do a little bit of digging to do that because that's the biggest question that people have if they happen to retire early or they don't have access to a workplace retirement plan. What do I do for insurance? So yeah, they could go to healthcare.gov on the ACA exchange, or you were able to find that in your area. I don't think I have a Farm Bureau in my area, but many states have that. So make sure if you are having to get your own insurance that you look at that as an option. So I appreciate you sharing your experience with that.
Yeah, it's a hack that works in Tennessee, and we're happy to have it.
Now, I did mention that there was a whole bunch of cool stuff that in regards to health savings accounts that didn't get in this bill, but that really doesn't worry me too much. I like the changes that have happened. However, usually there's not too much bickering on enhancing HSAs and adding things to them. So I wouldn't be surprised if down the road there was even more enhancements to HSAs. And you know, I follow legislation on that. So I will definitely keep everyone updated on any future changes. But with this bill, those are the primary ones that changed.
All right, Jackie. The next thing on your list today of things you've dug into are the child tax credit, dependent care FSAs, and tell us the difference again, please, and the dependent tax credit. Okay, what changed here?
Yeah, so we got a lot of parents in our audience, and obviously I was a parent, you were a parent now. Our kids are grown, so we may not qualify for some of these. So these are three different things, and I'll clarify what they are. So the child tax credit, that's given directly through the IRS on your tax return. The next two, the dependent care flexible spending account and the dependent tax credit, those are both in regard to the cost of care, not just for your children, but also you may have a dependent that's a parent or an elderly person. So that's why they use the word dependent care versus child care, because it could be both. For the most part, it is people are thinking about their kids, and because that's what gets really, really expensive, especially for an infant. So for the child tax credit, really small, but hey, it's going in the right direction. The child tax credit was raised from $2,000 to $2,200, and it is indexed for inflation. So that's good. That one's really simple. For the dependent care flexible spending, just a little nuance with this. When you have a health savings account, an HSA, you cannot have a medical flexible spending account with that. However, you can have a dependent care flexible spending account. They are compatible with each other. So they raise the annual contribution limit for these flexible spending accounts from $5,000 to $7,500. Thank goodness, because it's expensive, this childcare that you have to get, especially when they're little kids. It's effective for plan year starting January 2026. So I'm glad that they raised that, because Bill, I don't know if you remember when we was at the University of Tennessee, and Karen, the professor, when I was talking about my expenses were about $40,000, she goes, "Oh my God, I pay that much in childcare." $40,000. So it's not cheap. And I was like, wow, that's crazy. So for her to be able to pay for some of that tax-free or getting a tax break is a good thing. But she's got two little ones, but she was saying almost $40,000. So it's not cheap.
Just to remind our audience too, it's important. The semantics here are important. The health savings account is different from a flexible spending account in that the flexible spending account, the dollars don't roll over to the next year. These are dollars that you should be able to use in the year that you save them. But a health savings account allows you to invest and grow. And if you can cash flow your expenses and invest your health savings dollars, you get the triple or quadruple tax benefits in a health savings account. So if you get to pick one, pick the HSA every day, all day long.
That's right. Very good, partner. Again, the only one that's not compatible with an HSA is a medical flexible spending account. But with this dependent flexible spending account, it is compatible with an HSA. And Bill and I both have supersized our HSAs. We've got over 6 figures. So all of these that we're talking about obviously is going to impact people that are parents, where they're dealing with kids and high childcare. But here's a fun fact. So aside from a temporary increase with the American Rescue Plan Act of 2021, the limit was set by Congress in 1986 and has remained the same since then. So this lowers the cost of childcare, obviously, but unfortunately, it's still not indexed for inflation going forward. So this dependent flexible spending account, it's ridiculous that they set this amount in 1986. They did not adjust it for inflation. So this, even though they bumped it up to $7,500, it's still not adjusted for inflation, and the inflation rate of childcare is huge. So I thought that was crazy that it wasn't adjusted for inflation. So the very last one we have in this section, Bill, is a dependent care tax credit. Now, for the dependent flexible spending account, that's through your employer. You can only get that through an employer. This, you can be self-employed. You don't have to get this through an employer, but this is a tax break. You get this when you file your taxes, but it increases the percentage of expenses that you can claim. So it used to be 35%. Now it's up to 50%. So this is really nice. And then the credit is now fully refundable. So even if you're a low-income family where you're barely paying anything in taxes, you can get a refund and you'll get the full value of the credit for this. So that's a good thing.
All right, but you say you can't double dip, right?
Yes, so you cannot double dip. And when I say double dip, these two that I mentioned that were in reference to dependents, you can't use them both for the same expenses, but you can stack them. So again, because childcare is so high, the flexible spending account only goes up to $7,500. So what about the remaining $20,000 that you might have? So you can use the remaining dependent care credit. You just can't use both of them for the same expenses. They never like you to double dip. A rule of thumb always when it comes to taxes, you can't get 2 tax breaks on the same thing. I know you tried, Bill.
I try and play by the rules. Knowing the hard part, we have you here to tell us what the rules are. But the one that's interesting to me too, and everybody's talking about this, is the introduction of the Trump account or the child savings account. What's the skinny on this? This was very confusing. Has it gotten more clear since it first came out?
A little bit. It's gotten more clear that it's still as confusing as we thought it was. So these child savings accounts, if you're in a state where they might have had something called baby bonds, where they would give seed money to newborn children, typically they were trying to help out lower income people that might not have money to save or an investment account where they could actually contribute to. So it's kind of in the spirit of that. So here's how it works. Overall, I think it's great for people that have a newborn. Now, this is a temporary one. So if you had a person or a child, and as you know, I'm about to be a grandmother, so my daughter will have a child that falls within this range from 2025 to 2028, you have this extra $1,000 that you will get for any newborns born from 2025 to 2028. So if you got somebody pregnant already, they have the child this year, they would qualify to get the $1,000. This is the most attractive part of this whole section, in my opinion. Now, if you don't have a newborn, but you still have a child, you can still contribute to these accounts. You can do $5,000 a year per individual, and this will be adjusted for inflation. Your employer can contribute, family members can contribute, the employer or nonprofit can contribute. But the $5,000 a year, I think the really confusing part that you're talking about is, how are these treated? Are they like a brokerage account? Are they like a Roth IRA, a traditional IRA? It's almost like a mix of both or all three. And I'm just interested to see the first accounts that get open. Once the kid turns 18, the funds can be used for higher education, your first home, and starting a business. So that's where it's different from a 529 plan, because 529s is all about like education, training, and things like that. But with these accounts, they can use it for their first home and they can use it to start a business. Now, the most interesting part that I thought this particular rule pointed out was they specifically said, investments inside of it has to be a U.S. index fund, like an S&P 500. Again, this was specifically written into the 870-page law, and it must have a low fee of 0.1% or less. So this clearly has defined what a low fee index fund looked like. Now, Bill and I, we would debate back and forth what was considered low, because you look in some of these 401ks and you still got 0.5% or 1% or even 1.5% fees for funds. And now we've got this huge piece of legislation that has clearly said low fee is 0.1%. So it's out there now. I hope that 401k providers, employer-sponsored plans are taking note that this has been put in a major piece of legislation, and they should be able to find 0.1% expense ratio funds to put into their 401ks as well.
The gauntlet is thrown down now, right? You heard it here. And for these accounts, we've now defined what is low cost. And all of our brokerage custodians out there pay heed, because the government's going to give folks access to this. Will it run through like a TSP program? Who's going to hold this? The government? And what funds are going to be available? We don't know, right?
Right. All of those we don't really know. So I'm sure the IRS is scurrying with the few people that they do still have left working for the IRS. They're trying to figure out, how do we implement this? So I don't know. I wonder if delays will happen or what will happen in trying to get this actually implemented. Now, just as a benchmark, again, I did a little more digging. The TSP, the Thrift Savings Plan, that is the government equivalent of a 401k, they have all of the information about their TSP employer-sponsored plan publicly available. So I went and looked. I said, you know what? I wonder what they're charging for their S&P 500 fund, and that is the C fund, C like Charlie. And the expense ratio for that S&P 500 fund is 0.04%, clearly under 1%. And I just don't think it's super hard to find low-cost index funds that are less than 0.1%. Us in the FI community, we know how easy it is. I'm pretty sure VTI is probably less than that. VTSAX, VUG, all of them are probably somewhere under that 0.1%. But I was very happy to see this bill. I feel like it's a hat tip to Jack Bogle that started these index funds, and people in the industry thought that he was crazy. But now we have a very, very strong reference point on what a low-cost index fund should look like.
Yeah, and I think these are going to be handled mostly like a traditional IRA, right? Where on the back end, the funds come out taxed as ordinary income, right?
Yeah, it depends. So while the account is growing, you don't have to pay. It's deferred growth. It's not like a brokerage account where you would have to pay if you sell something, if there's capital gains or whatever. However, at the end, once you're over 18, they may get treated like a brokerage account. When I was hearing about these, I'm like, okay, from a tax treatment perspective, is it like a 529? Is it like a brokerage account? Is it like an IRA? So really none of those. So they're creating almost an entirely new line item for the type of account, like we needed more types of accounts or tax treatments. So it's not purely any one of the existing tax vehicles. So more to come.
Let's make it tangible for folks. You've got a grandchild coming. You have the ability to work with this account. What are you and or your daughter going to do with this?
Well, I told her I will handle this, okay, because she'll have a lot on her mind when she has the baby. So my intention is to take the $1,000. I really don't have much of an interest to contribute on an annual basis to this, but I will take the $1,000. I definitely want to look at the paperwork and the terms and conditions so that I clearly understand how the taxing works. Generally, they need to be 18. When they're 18, they get some flexibility to take it out. And I think when they get a little bit older, they are able to use it for anything. And that's when I think it gets treated like a brokerage account and it's capital gains. So in my opinion, the first thing that I was going to set up before I even knew about this was going to be a 529. And I like the idea of a 529 now. And that's going to be our next topic because they have expanded 529s. I used to call it 529 college savings, but it's not just for college anymore. But I want to set up a 529 because if it's not used, up to $35,000 can be converted to, or it can be used as a funding source for a Roth IRA. Now, the grandchild would still have to meet all other qualifications to open up a Roth IRA, and it can only be funded annually by the amount that whatever her earnings were or the IRS limit. So I like that if the money is not used for college or any other qualified expenses, you can still use it as a funding source for Roth. So it's a great way to seed Roth money. And for someone that's that young, it could look pretty healthy. It could get pretty healthy. That's my plan for my granddaughter. Again, I want to learn about how this is actually going to be executed. And I may end up changing my mind depending on that. So we'll see.
So if you're in this 3-year window, you get your $1,000 and it's only one time. It's not $1,000 every year, right?
Correct. It's just one time for newborn kids. You can contribute the $5,000 a year if you want to for any child under the age of 18. It's 4 years, 25 through 28. So 25, 26, 27, 20. So it's 4 years.
So potentially these accounts will still exist after 3 years, but they won't get the $1,000.
Correct. Now, even though it's temporary, everything that we mentioned that's temporary, it does open the door to say, hey, maybe we extend these. Just like that Tax Cuts and Jobs Act, it got extended. It started out as temporary, but it certainly opened the door. So at this point, it is temporary, but for all we know, the next major piece of legislation, the major tax law, may end up extending it. But for now, it ends in 2028 in terms of that $1,000 seed money.
Yeah, and how would this compare to an UGMA type account?
I think it's a little bit more advantageous for that. And the interesting part will be, okay, when you're filling out the FAFSA form, do these child savings accounts count as assets for the child? So that'll be interesting to know. I think with an UTMA, the kid automatically gets the money, unified gift to minors transfer, or something like that. So the kid gets it at 18. They can use it for anything they want, and you have to relinquish ownership. I'm not the biggest fan of those. I much rather a 529, but you have to look at your individual situation to see what works. But if I'm comparing the new child savings accounts versus the UTMA, I would see the child savings account might be slightly better because you don't have to, if you sell something, you're not subject to capital gains during that time. And of course, you get the extra $1,000 if it's a newborn child.
So we're basically going to have a Trump baby boom.
Look, I think that's the secret message. That's the hidden message, that he wants more kids. Could be for a lot of different reasons, but the amount of newborn children over the last 10 years, I think, has declined quite a bit. And the hidden message is that, hey, this may be a way to get people to have more kids. We'll see. My daughter was already pregnant by the time this came out, so she wasn't drawn in by this. And I don't know if it will convince more people that they should go ahead and have a kid or not, but that's sort of the dangling carrot there.
Yeah, well, stay tuned. Maybe we'll have to have an episode just on how do we proactively save for our kids' futures using all of the accounts available to them, say before they have earned income at age 14, where we can use a Roth IRA, because there's lots of vehicles here, and strategically going forward with the cost of houses, the cost of education, thinking of helping our kids get a leg up in life without going into debt to do so on the front end when they're 0 or minus years old is going to be important, I think, in the future. So blending these accounts in the most strategic way possible will become important for the intentional parents among us.
Yeah, good point, Bill. And just to clarify, these aren't mutually exclusive, so they can use multiple ones and be strategic about it. It doesn't have to be one or the other. None of these say that you cannot hold the other account. So you might want to use multiple vehicles. You're not limited to just one.
All right, we got a few more things to go over. You hinted at 529 plans. Take us through what's new and different.
They keep expanding what you can use these 529 plans for. That's why I stopped calling them college savings, because you can use them for so much more. So the big expansion came with K through 12 expenses. So as of July 5th, 2025, it includes a lot of non-tuition type costs for K through 12. So things like curriculum materials, fees for standardized tests. I remember to get into college, I had to take a SAT test. Some people have to take, I think it's the ACT test and things like that. You can use it for books, instructional material. There's dual enrollment, which in Phi community would definitely encourage dual enrollment. It's almost a good way to get some of your basics of college out of the way. So you're pretty much going to high school and college at the same time. Educational materials that are online, tutoring services and things like that, and specialized strategies that's designed to support students with disabilities. So that list goes on and on. So I was happy to see that they did expand it. And not only did they expand what qualified expenses are, but in 2026, the annual limit for these K through 12 withdrawals, it increases from $10,000 annually to $20,000 annually. Now, if someone's going to private school, that's going to get pretty expensive. So $20,000 probably still won't be enough, but there's a lot of expenses that you can cover in K through 12 now with the 529 plan.
Yeah, I mean, it's nice to see that it's more robust. And I think that the change you talked about before with regards to what do you do with any extra money in 529? Say your kid chooses not to go to college. Say they go to a state school and they don't need as much, or they're not going to grad school, and you've got this extra 529 money there. You've got, as you mentioned before, $35,000 that you can convert for them into a Roth at a young age that turns into tax-free money and tax-free growth later in life. This is a huge thing, right?
Yeah, I'm glad that they increased the amount. They doubled the amount from $10,000, $20,000 annually. But I'm a little salty with the fact that they did not increase how much you can use out of your 529 to pay back student loans. It's still a $10,000 limit lifetime. And I'm like, okay, with all these issues we're having with student loans, we're complaining and saying, oh, student loans are out of control, people are not paying them back, and all kinds of debates about it. It's like, why on earth did we not say, okay, we're increasing the K through 12, why not increase the student loan? I mean, I digress. That's nowhere in the bill, but I kept looking and I didn't find anything like that, because that could be helpful with these student loans, both for parents. They could help pay back a kid's student loan or something like that, or the adult themselves. If they're just ready to have them paid off, maybe they are able to funnel it through a 529 and help with their student loans. But anyway, I digress on that one. Sorry.
No, you're not digressing at all. I didn't even know this. And it is important because say you're doing a 529 hack, and we'll have to have a show on this too, where the grandparents create a 529 with themselves as a beneficiary so that it's not on the FAFSA, so that they can get student loans. But in the back end, I didn't know that you couldn't take more than $10,000 or $20,000 to pay those off. So 529s are prospectively to a great advantage, but if you want to retrospectively help folks with their debt burdens, your hands are tied, right?
Yeah, it is. Maybe in the future, they will expand that again. These $529 or these vehicles have just expanded more and more over the years. So I don't think it's far-fetched to think that at some point they will increase the amount of $529 you can use to cover student loan expenses. I think it would be a smart thing to do something with that. Yeah, here's another thing I really like, Bill. So qualified withdrawals, they now include post-secondary credentialing expenses like exams, CEs, fees. And for you and I both, we have credentials. I'm a CFP, you're an MD. We have to pay to renew our license or renew our certification, and we have to pay to get continuing education. Now we can use our $529 for that.
Yeah, I mean, these are things I did not know. There is so much more. We have to have a whole episode on 529 plan. It's gotten that tricky, and then ways to really leverage these into enhancing our financial lives, because this is an important thing. Education is not going away. We're going to need it. But we can go to the trade schools and other schools, not just college with these two things, right? So there are many ways to take advantage of these things that I might not have thought about before.
Yeah, and you have to keep your certifications up to date for many things in the trades like plumbing, HVAC, electrical, all of those things. So not just in a traditional college. So that's what I love about this. Again, 529s are expanding, and I really like that the hidden message here is that we know training and education is not just inside of a classroom at a traditional college or university. So thumbs up to that. One other highlight, there was some discussion about this in our Facebook group, is that there's new ABLE provisions. So ABLE stands for Achieving a Better Life Experience. It's currently set to expire in 2025. It will become permanent. And the law makes it possible to roll over funds tax-free into a 529 account. So these are people that have disabilities and things like that. And they work very similar to a 529, but they are allowing people to roll over funds tax-free from a 529 to an ABLE account. So clearly there is so much flexibility with the 529s now. I don't doubt that it will continue expanding. So I'm really happy to see these changes, with the exception of nothing done with the student loans. I'm happy to see the changes that were made in this area.
All right, we got a couple more things to get through here. This big, beautiful bill is a big, beautiful pain in the butt.
It is big. So we've got only 2 or 3 more that we want to do. And actually, they're the shorter ones, but they were worth mentioning. Bill, I know you love charity. You have a donor advised fund, and all of our guests, we ask them about the charity. So one nice little change that I like is that the charitable deduction, now you can take up to $1,000 deduction even if you're not itemizing. And like we said, most people do not itemize to take the standard deduction. So if it's a single, it's $1,000. And if it's married filing jointly, it's $2,000. Typically, except like during COVID, I think they gave us $300. But typically, if you take the standard deduction, you can't get any kind of tax break for the donations that you made to nonprofits. Now you can up to $1,000.
No, I think this is great, actually, because although we use a donor advised fund, and I'm a big advocate of that, and we will also have an episode on these as well. But everybody's going to use their credit card on some website to donate money when the spirit moves them. Well, now you can deduct that without itemizing, and you got to save your receipts or keep track of it somehow. But I can think of a lot of us, or most of us, that would give up to $1,000 or $2,000 that we wouldn't think of, and now we have to remember it because it comes off our taxes. Right. And so we'll do this in addition to using our donor advised funds, because even though you can add a donor advised fund to the donation port of a website, people don't do it. They still want to make it easy and use credit cards, which I think is the worst way to give.
Yeah. Well, one little thing about your donor advised funds, or if you itemize, now the floor is 0.5% of your AGI you cannot get a deduction for. So it has to be above that. Now, to me, that's nominal. That's pretty small, but you're going to be giving up as an itemizer. That doesn't start till 2026. So here in 2025, you still have time at the end of the year where if you, let's say, fund your donor advised fund, like how often do you fund your donor advised fund, Bill?
We stacked it back when we originally funded it. We stacked 2 or 3 years worth of contributions into one to exceed the standard deduction, so we would see more tax benefit. And that's what's usually recommended is, okay, if you're going to give this much over the next 3 years, just give it all at once on the front end so you can itemize and see that benefit. But it's going to be a little harder donating annually to a donor advised fund because you may not see the benefit.
Right. And not giving tax advice or anything, but because in 2026, you needs to be, 0.5% of your AGI, you're not going to be able to deduct. In 2025, there is no floor. So it might be smarter to, if you're doing it donor advised fund to cover multiple years, it might make more sense to do it in 2025 over 2026. Minor difference. And again, it's not tax advice, just something to think about. And for the $1,000 deduction where you don't have to itemize, or $2,000 for married filing jointly, it does have to be cash or cash equivalent. So like a credit card, a debit card, a check, or something like that. Now, Bill, I'm going to fess up to something. I want you to tell me if this is too frugal or a crazy FI thing to do. So there was a gentleman that was in my investment club. He passed away. And instead of giving flowers, he had these 2 charities. Now, this was this week. And I'm thinking now this $1,000 and $2,000 is only effective starting in 2026. So I'm like, okay, I'll make the contribution on his behalf, but I'm going to do it on January 2nd so that I can get the deduction off my taxes.
That is a little bit of a FI hack, and it won't add to the total raised because of his passing, unfortunately. And this does exist. And what happens with this for us is I will typically go to the nonprofit directly and donate to that nonprofit, and not necessarily through the GoFundMe or whatever website it is where it automatically gets tallied in. And then I have to tell the person that I went in the back door through a donor advised fund. Please add it to the total that you raised, because it won't naturally get counted unless you do it through the front door. And you are hacking it, but you might have to give double now.
Right, exactly. I might have to, maybe I'll give a little more since I'm doing it in January. But clearly, he was a longtime member of both of these organizations or contributed to them. And so, in his memory, I will make the donation. It's just, should I wait a few months and do it at the beginning of 2026 or not? I probably will go ahead and wait, but maybe he'll get a little more, or his charity will get a little bit more. And just another reminder about donor advised funds. Remember, $1,000 or $2,000, if you don't itemize, it has to go directly from you to the charity. So donor advised funds would not be included. Now, you said you give extra above and beyond your donor advised fund, but I just want to throw that out there so people knew that that can't be a funding source to make the donation where you will actually be able to do it if you don't itemize. And then there's no income limit phase out. So even if you make $500,000 a year, whatever, you don't have to worry about, is there an income limit to be able to do this? Everybody can do it. No income limits.
There are creative ways to give. Giving cash may be the least creative, the least impactful, because if you give appreciated shares, then all those gains pass through and nobody gets taxed on the gains. If you're given cash, you're given post-tax dollars. You can give more if you give appreciated shares with embedded gains. And we'll talk more about fun stuff. We got more.
Now, here's fun stuff, but it may not impact a ton of our listeners, but I sort of lump these together. These are some new temporary deductions that we have not had before. They're only good for 4 years, so 2025 to 2028, but you do not have to itemize to get these deductions. And these have been all over the news as well. They've been highly talked about. So you may fall into one of these. So the first one is no income on tips. Okay. There are limits to this. Okay. So you can deduct up to $25,000 in cash tips. It phases out at $150,000 AGI if you're single, and then if you're married, it's $300,000. So this was kind of crazy, but if you get no deduction for taxes on tips, if you are married filing separate, I'm like, where did that carve out come from? So if maybe you are about to get a divorce and you no longer file taxes together, you do not qualify for this deduction. So sometimes I feel like things might have got left off by mistakes or whatever, but just want to point out that little nuance.
Yeah, no taxes on tips up to these amounts. I mean, that's great. I worked in the service industry. We've had Barbara Sloan on the show.
Tipped finance.
Exactly. Go back there. She talks all about service workers. This is a big thing for her and that population of people in the FI community. Big fan. Yep. And we'll have to have Barbara Sloan back on briefly to talk about it.
Yeah, it was really cool. We definitely need to get her take on whether she thinks that helps or not. And I don't know if you knew this, Bill, but obviously we worked in the service industry when not everybody was using credit cards. But my daughter, she worked a little bit at a restaurant as a waitress. And when we were doing that, the older people would tell us, you don't count all of your tips because you would get them in cash. Well, now most tipping is done on a credit card, which goes through the employer system, and the tip is tracked much better. So some people, they might not be able to, if it's a cash tip, maybe they don't count it all. I don't know. But a lot of these tips now, if they're on a credit card, is like massage therapists, waiters, waitresses, and things like that. It may get tracked where this no tax on tips might be helpful. Okay, so the other one is overtime. I have a brother that works where he gets overtime, a sister as well. So this is kind of cool. You can deduct up to half as much. You can deduct up to $12,500 and $25,000 if you're married filing joint. And it also has the same AGI phase outs, $150,000 for single, $300,000 for joint. Again, there's no deduction if you are married filing separate. So I don't know. It's just a little crazy that they leave that out. But if you are in a traditional industry where it's overtime, and I think employers are going to have to figure this out. Like, I don't know if current W-2s actually separates that out, but you can get up to a $12,500 deductible.
This one's a little hazy to me because if you have a side hustle and you're functionally doing overtime, but it's not with the same employer, who defines overtime? And I'm confused by this one.
Yeah, I think some people will end up not getting credit for the overtime. I'm pretty sure it's just one employer because the one employer doesn't know what the other employer is doing. So again, it will determine how the IRS actually executes on this. So that would be interesting. And then the overtime, that $12,000, let's say if you already worked 40 hours, you get $20 an hour. All right. So your overtime would be, if it's time and a half, it would be $30. So you're only going to get to deduct the amount over your normal $20 rate. So it may not be as much as you think, but these employers are going to have to figure that out. Maybe they'll get some guidance from the IRS. But if you're in that type of industry where you get the overtime, I'm thinking it's probably per employer, but that's for the IRS to figure out.
Yeah, or is it calculated on an annual hourly amount where you have to work this number of hours before it's considered overtime?
Yeah, and in most states, it is 40 hours for the week. I believe in California, they go by the day. So there might be some nuances with each state as well. So, yeah.
Well, they're just promoting us to work more and less work-life balance, Jackie.
Exactly. So this last one here might be a non-fi thing, but for new car loans, there is a car loan interest deduction up to $10,000 per year, but only for cars that have been assembled in the United States. So my daughter, she's got a new baby coming. So she's got baby in the brain and she wanted a new car. Now, in her defense, she did have the same car for the last 17 years. So that's a very fine thing to do. But with the baby, she insisted on getting a new car. And I tried to talk her out of it. I tried to talk her out of it and say, hey, why don't you get a car that's a few years old? Well, she didn't want to. And it happens to be a Kia. Now, she thought she wouldn't have qualified for as a U.S. assembled vehicle. So it doesn't have to be a U.S. brand as long as it was assembled. Her car was assembled in the U.S., so she will get this deduction. Now, I've heard some people kind of go all the way in the other direction saying, okay, if it has phase out limits. So if you're single, your AGI starts to phase out at $100,000. If you're married filing jointly, it's $200,000. So a lot of planners have been, well, you shouldn't get a car where it's $10,000 in interest for a year. Well, here's the thing. It's not saying you have to have interest up to at $10,000, but maybe close to. Even if you only had interest, that's $2,000 for the year. That's better than nothing. Or $3,000 for the year. That's better than nothing. So take it, enjoy it. I'm not a big fan of new cars. I don't think you're a big fan of new cars, but if someone is getting a new car like my daughter, it's nice to know that, because this has never been done before. So it's totally nice to know that you can get a tax break on the interest on loans. And again, these are new cars only that was assembled in the U.S. And you can tell that by checking the VIN number. It will tell you where it was assembled.
Yeah, this is a little bit of discrimination against the used car, don't you think?
I think it is, Bill. I'm only guessing. Again, the hidden message, I think, is that they are sort of propping up the car manufacturers a little bit, because they're the ones that sell direct to dealerships that then sell to the consumers. And I'm assuming that the used car industry, the volume would be a lot greater than new cars. And it's encouraging buying cars in the U.S., so I totally get that, at least that they were assembled in the U.S. But yeah, I wish I could get it for a used car. That'd be nice.
Yeah, I mean, in a way, it's promoting buying new car debt. This is a little bit anti-fi or fire. I don't really see a true benefit here. And remember, at the same time, we're not talking about the fact that they're getting rid of all the green credits. You're not getting credit for buying an EV. You're not getting credit for buying solar panels or insulating your house. Those things in the background are going away. So I guess Elon Musk loses on the solar, but gets it back on the new car interest.
Yeah, he's had all kinds of trouble, so we'll see where that all goes. I wouldn't say that it's anti-fi, because you do have some FI people that will buy a brand new car and they'll keep it for 10, 15, 20 years, and that's how they do it. But I hope it doesn't encourage people to buy a new car when they were going to buy used. Still do the math, run the math, and see if it makes sense to do that.
If you think about it, it's like have a new kid in the next 3 years, buy a new car, and you better put your solar panels on your house this year.
Yeah, let me add to that. This very last one, don't get student loans because the student loan changes. Travis Hornsby was on the show. He is the genius when it comes to student loans. So he is the one to follow if this is you, where you have student loans or you expect to have student loans, or your kids are about to go to school and you're worried about student loans. So we're just going to hit a few of the highlights and then we will wrap everything up. But student loans, there was a huge overhaul of the student loan system. For undergraduate subsidized loans, that's largely unchanged, but the Parent Plus loans, there were changes. The Grad Plus loan programs are changes, and they're being phased out for new borrowers. after July 1st, 2026. That's a big deal. Borrowing caps. Now, Bill, you're a physician, and I know when you went to med school, things were very cheap, but we know that's not the case today. So some of these caps are going to be really hard to get through medical school, law school, and some of these advanced degrees. But here they are. So for non-professional graduate students, it's capped at $20,500 per year. And then there's a $100,000 lifetime limit. For professional degree students like medicine, law, dental, it's capped at $50,000 a year and a total of $200,000 lifetime. So we know some of these med schools are very, especially if you're going Ivy League, you're going to one of the big schools. I don't know, how realistic is $50,000 a year, Bill, to get through medical school?
It ain't going to cut it. The last time I checked, the average professional dental students come out with $300,000+ of debt on average, and med students come out with about $230,000 to $250,000. So when you see that mint fresh new doctor out there and you think they're rich, their net worth is less than yours. Their net worth is probably $250,000 negative. So things are not all roses on this side of the world. And I am really concerned about these things. There is an upside in a way where it caps things. It's going to put pressure on the schools not to inflate tuitions, maybe. So there may be an upside on this, but it's going to be really hard. I did not know these. And we need to go through these with Travis, because this is rapidly evolving, a very complicated area and very politically
charged. Absolutely. Yeah, Travis is talking about this stuff almost on a daily basis. So follow him on YouTube, go to his website. I will drop the link. We do have an affiliate link for him only because we know that he's amazing. He's like the best in the business, but he does student loan consultations, because some of these things are a little bit scary for some people trying to either pay back their loans or trying to get through school. And you're right, maybe it will put pressure on the schools. I just wish they would have started putting pressure on the schools to begin with, because that's a big part of the problem. To me, when you are focusing on the student, I didn't have anyone guiding me at age 16 and 17 on how much I needed in student loans. So you're basically blaming the 16 or 17-year-old kid. Not everyone has mommy and daddy holding their hand saying, this is what you do. Not everyone has mommy and daddy paying for their school. So with these caps, the alternatives are going to be get a private student loans, which sometimes can have high interest. You're not getting all the benefits that you get from a government student loan, or your parents will pay for it if you're lucky that way. But these students are going to have to make some hard decisions. So here's back to the Parent Plus loans. Those are $20,000 a year and a maximum of $65,000 per child. Overall lifetime federal cap is $257,000 across all loans, excluding Parent Plus loans. So this is combining the undergrad, the grad, and the professional degree. So that sounds like a lot. And it's crazy that even that big number still might not be enough to get someone through undergrad all the way through getting their medical degree or their law degree.
This is scary stuff. I'm just happy that we're on the other side of this already.
But we got kids and we might have grandkids.
We got to rethink it. It's going to require help. It's getting to the point where buying your own house, getting your own education, it's hard to do it by yourself, and families have to pull together and take care of each other.
Right. Not huge changes with undergrad loans, so I'll skip that. But for people that have loans currently, there's a repayment plan overhaul. So there was something called SAVE that just came about the last few years. That was the most beneficial. That's an income-driven repayment plan. All these income-driven repayment plans, they're going away. Okay. You'll have a few years to get everything transitioned, but now they're replacing it with something called the RAP plan. And let's see what RAP stands for. It's called the Repayment Assistance Plan. Okay. So we need another acronym in this space, right? But it is income. It's going to be the only income base for people getting new loans and for anyone that already has a loan. Again, there'll be a transition period. So the payments are capped at between 1 to 10% of your income. And forgiveness is 30 years, which is a lot because some of these other income-driven repayment plans were 20 years and 25 years. Now we're getting a mortgage here, right? 30 years is for this repayment assistance plan. This new one that is coming into play is based on a 30-year schedule. So it's like you're getting Social Security and you're still paying back your student loans. It's gotten a little crazy. Hopefully the schools will fall in line and realize that they have to do something different. A little bit crazy. So again, not a ton of changes, but our best resource for student loans is student loan planner Travis Hornsby. And you need to think about, okay, what are the other options to pay back student loans? Some employers are starting to allow it. Some employers will have tuition assistance. There's a student loan interest deduction. And just remember, you can use $10,000 lifetime from a 529 plan to help pay this off. Those are some nominal things compared to those big numbers we just went over. But Bill, I think about when we had Christy and Bryce talking about the POT score, the pay over tuition. That's going to become even more important when you are looking at how much tuition costs versus how much you're going to be making. Will you be able to pay back those student loans in a reasonable time?
Yeah, I mean, they're Quit Like a Millionaire book goes through this, looking at expected first incomes compared to your student loan burden. You don't want to go to Harvard and become a social worker. That's not tenable. In reality, it's like your student loans should probably, rule of thumb, be no more, if possible, than 1x your first annual salary. If you're more than 2x that, you could potentially be in trouble. For example, you have $40,000 in student loans, you come out and you're a $40,000 a year social worker. That's probably tenable. But remember, you got housing debt and other debt that you're going to pile onto this. So you got to look at the total debt burden you're looking at starting your life. If you have $200,000 of loans and you're a $40,000 a year social worker, you have just married yourself to the financial industry for life. So we've really got to look at these things prospectively for our kids, for our grandkids, if we haven't for ourselves, so that people don't end up unconsciously digging a hole that is really hard to get out of.
Yeah, Bill, I think the people that are going to fare the worst were people like me. I was a first generation college graduate, the first person in my family to go to school. So I didn't know about any of these things. And I was applying, filling out the FAFSA, which was called something different back then, but I barely knew what I was doing. So for anyone else where they're the first one going to college and they don't have the guidance and they don't have parents or grandparents or aunts and uncles that will help hold their hand, or maybe even a school that will help give them guidance, they're kind of on their own trying to figure this out. 16, 17-year-old just saying, hey, I heard that going to college will get me a better job, which is what I thought. So I think they are going to be the ones that's kind of left out in the cold trying to figure this stuff out themselves. So if you do have any young person in your life, maybe they're not a family member or whatever, but you realize that they don't have anyone else helping them, see if you can help them out. So the 2 episodes that we did kind of around this stuff, again, if this impacts you and you want to do a little more digging, episode 93 was with Christy and Bryce of Quit Like a Millionaire, that talked about this pay over tuition score. And then Travis Hornsby, he was on episode 122 that talked a lot about student loans. Now, this was before this law passed. We do have to have him back again. But I wanted to save this to the end because this, to me, was probably one of the biggest areas that's going to impact a lot of people. There's a lot of changes, an entire overhaul of these student loans that, as we know, drag a lot of people down, causes a lot of stress, and has a huge impact on a person's FI journey.
Yeah, we even talked to Krista and Ed about their situation because they were a case study and they had a student loan issue. And how has this impacted them?
Yeah, so this was episode 97. So this was last year where most people thought that, so there was a provision that said any forgiven amount of student loans would not be taxed. Okay, so I dug into that, and they were going to pay off their loans, or their loans was scheduled to be forgiven after this law expired. And I said, I don't know if the law is going to expire or get extended, but I want you to be ready. And they decided to set up a separate account to cover the taxes on the forgiven amount. And I guess that's another thing that's in here, or they just allowed it to expire where there is a tax on the forgiven amount unless it's public service loan forgiveness or a few of the other things. So for them, they will be forgiven after 2026, which means that they will be responsible for the taxes, not only on the federal level, but I think they were in Wisconsin. Wisconsin never followed suit, even with the temporary law where they didn't have to pay taxes. So I can't remember how much they potentially could be forgiven. I want to say it's around 30 or 40,000. So they're going to get a tax bill on $30 or $40,000 or whatever the amount is forgiven. But I'm so glad that they decided to set aside an account, because I'm like, it's better to have it and not need it than to need it and not have it. But that was a big part of the story, these student loans.
Yeah, I mean, we have so much to learn from our case studies. We've had several more recently on the show that are doing really well. If you are somebody that wants to tell your story to our late starter audience, reach out to us at Bill or Jackie at catchinguptofy.com. We'd love to tell your story so that others can learn from you.
That's right, Bill. This has been amazing. I nerd out on this stuff, so I was digging into it. I just felt like some of the areas that were talked about missed some of the nuances that I thought were important for our audience. So Bill agreed to kind of do this recording with me, because I want our audience to hear from us and the research that we've done that's specific to our listeners. And this bill was so big, it was just so much to cover. So we probably didn't even cover the surface. Not that anybody want to read through the whole thing, but we'll include a link to the whole 870-page bill that actually got passed. It got signed into law on July 4th, 2025. We're coming to the end of the year. So these are things that you definitely want to pay attention to.
And then the other thing that we got coming up too is we're going to have Cody and Sean on the show. They got a new book coming out, Tax Planning for the FI Community. It's coming out this October, I think it is. And there's a lot of material out there about it already. They've sent us an advanced copy, and there's going to be a lot of tax stuff that we can go through for this audience that they've put together into a book. I can't wait to talk to them.
That's right. It's going to be a lot of fun. But yeah, we love to educate you. And I kind of put on my CFP hat to dig into some of this, because I had to study hard for the exam. But I definitely want to share. There's been a lot of information. So part of what we're trying to do today is educate you on, give you a little more clarity on some of these laws that's coming down. So this was a great conversation. Thank you, partner, for having it with me. Love it. And I hope that our audience was able to pick up a little something more about these new tax laws.
Well, I know I'm less confused than I was before, and that's a good thing.
Yay.
We'll see you guys next week on Catching Up to FI.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. Our social media maven is Diana Falk, and our editor is Fritz Brazard. We love them, and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofy.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to FI. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to FI. Cheers.